Trading Oil Futures by www.profitabletradingtips.com. Oil futures trading has been active as prices have fallen over the last months. Factors driving oil prices down are the continuing U.S. oil fracking boom, continued high OPEC production, and slowing economies in Japan, Europe, and China. The U.S. Federal Reserve says that shale production is steady despite the global excess, and the OPEC decision to keep production high was recently in the news. In early November, oil and gas exploration activity decreased in North Dakota and increased in Montana relative to a month earlier. Production remained at record levels, the Fed said. Despite recent declines in oil prices, officials in North Dakota expect oil production to continue increasing over the next 2 years. Oil prices have declined since June and touched a 5-year low early this week, reflecting in part slowing global economic growth and increased domestic production in the United States. Oil prices respond to supply and demand, and while production remains high, demand is falling due to economic slowdowns across the globe. Trading oil futures depends on careful analysis of these fundamentals, as well as the sentiment of the market. With traders expecting that the market has overshot, many have bet on a recovery of oil prices. Up and down. Markets tend to be inefficient, and successful traders take advantage of that fact. Trading oil futures is no different. Morningstar notes that oil futures markets remain jittery despite a recent small uptick. Crude oil futures rose in Asian trade Wednesday, but analysts expect prices to remain volatile and market sentiment is still largely bearish. On the New York Mercantile Exchange, light sweet crude futures for delivery in January, CLF5, traded at $67.10 a barrel, up 35 cents or 0.5% in the Globex electronic session. January Brent crude on London's ICE Futures Exchange rose 29 cents or 0.4% to $70.72 a barrel. If the market is looking to U.S. shale for a price floor, Citi thinks that floor is nearer to $50 a barrel for WTI than the $90 a barrel level frequency cited by senior Saudis in recent weeks. Edward Morris, head of commodities research at Citigroup, said in a report. If the Citi analysis is correct, there is a greater downside to the oil market than many thought. Who suffers? Many U.S. companies have invested heavily in looking for shale oil and using high-tech fracking technology to extract it. These companies carry a high debt load. So long as they were getting $100 a barrel, many could profit, but as prices fall, there are oil companies in trouble. Some could simply fold and quit producing oil. For those trading oil futures, this could mean lower supply and higher prices. MarketWatch refers to the survival of the fittest in the oil fields. Companies are dusting off contingency plans that may have seemed far-fetched when oil was trading above $100 a barrel in the summer. Oil well and land portfolios are coming under renewed scrutiny as they decide where to wait it out and where to continue production. Since it costs Saudi Arabia and others about half what it costs in the USA to produce a barrel of oil, this may turn into a game of chicken that the Middle East will eventually win. For the person trading oil futures, the issue is deciding when oil will have bottomed out and starts to rise. For more insights and useful information about trading stocks, commodities, or Forex, visit www.profitabletradingtips.com.